fundamentals. We have spoken about the US dollar, and I have outlined that all in all, analysts expect stronger growth and inflation next year, and the base scenario is that this will be more or less true. Here is the monthly chart of the US dollar index, which tracks the dynamics of American currency versus the currencies of America's main trading partners. And we can see that after some consolidation which took place in 2015 and the most part of 2016, US dollar index managed to break above 100-point resistance on the upside, and currently is trading around 103 mark. And after clearing this resistance, a way is open for the US dollar to retrace more and to visit levels around 110 points for the US dollar index, moving towards the levels we last saw in 2002. So if the Federal Reserve sticks to its intention to raise interest rates 3 times next year, if the US economy is good enough to provide the opportunity for the US central bank to do so, and if Donald Trump does the policies expected from him, like the fiscal stimulus, but is rather moderate about international policies and changing some trade agreements with Canada, Mexico, and China. If all is more or less well, then the US dollar should have bullish drivers here. The picture for the euro is different. The European Central Bank has tied itself with loose monetary policy, and although some reductions in the monthly purchases of the bonds and other assets will take place beginning with April 2017, still the European Central Bank made sure that the market understands that it will be present at the market during a long time and will be doing its aggressive monetary easing policy during a very long time in future. So this loose monetary policy of the European Central Bank is in very bright contrast with what the Federal Reserve is doing. And taking into account high political risks we have discussed about the euro area, well, I think that it is very likely that the euro will move downside to levels around that parity, around $1 per euro, and maybe even lower. So these are the target levels for the euro, and we expect the euro to remain under pressure. Also, probably we can have a look at the weekly chart of the euro dollar. Just this week, the pair broke below 105 mark. We broke below support line, which was limiting the downside in 2015, and as a result, the overall setup looks very negative. We have a kind of rectangular or flag pattern, and the odds are that the overall negative trend will continue below 105 to levels around the parity here. So the really negative developments are taking place in the euro dollar currency pair by the end of the year. And of course, much will depend on the policies of the central bank. It is kind of difficult to speak for the year as a whole, but we do have this outline, this layout for now. British pound is surely undervalued at the current levels, and the odds are that it will somehow try to recover during the next year, especially if inflation picks up in Britain and the Bank of England has to adjust its monetary policy, try to normalize its monetary policy a bit. But as I have already mentioned, we are currently waiting for clarity about the Brexit process. The market wants to know whether we'll have a soft Brexit or hard Brexit. So probably British currency will remain under pressure, at least during the first part of the next year, during the first quarter, and then we'll have more details about Brexit in March 2017. And if it is a soft Brexit and there will be some conditions on which the UK will be able to remain in a common market with the European economies, then this fact that pound is undervalued and the fact that it is still trading significantly lower levels which we were before the Brexit vote. It is trading below 1.40 and at the levels even lower than 1.25 at the moment. This downtrend should reverse for GBPUSD around the end of the first quarter and maybe in the second quarter. For now, we still have this downtrend in place, and as we are looking at the chart, below 1.25, the GBPUSD is vulnerable for 1.22 and in the longer term to 1.20 mark. So this is what we can say about the British pound. As for Japanese yen, Japanese economy is operating in the conditions of weak growth, loose monetary policy by the Bank of Japan, and of course we'll see occasional spikes in demand for the Japanese yen as a safe haven. Still, all in all, yen is likely to be weaker next year. And all in all, I think demand for this currency won't be very high, taking into account the contrast between the monetary policy of the US Federal Reserve and the Bank of Japan. We can expect further upside for the US dollar Japanese yen currency pair. And we are now seeing that the pair has retraced almost 70% of decline since 2015 to 2016, and our more bullish levels lie ahead for the US dollar Japanese yen, levels around 125 and maybe even a bit higher. The trend won't be as rapid as it used to be up to this point probably, but the bias for dollar yen will likely remain bullish next year. As for another safe haven currency, Swiss franc, the Swiss National Bank will likely continue its attempts to limit Swiss franc strength, and surely tighter monetary policy of the US Federal Reserve will help the Swiss regulator to do this. So if we look at dollar franc and put on the weekly chart, here probably a bit too many indicators, but still I hope that you are able to see that there is a bullish bias in dollar franc, and this mild bullish bias is expected to continue in 2017. As for commodity currencies, Australian dollar and New Zealand dollar, much will depend on dynamics of commodities. But if we are talking about Australia, here we are in the situation of slower wage growth, which is an important factor. So there is a chance that the market will once again start expecting the Reserve Bank of Australia to reduce the interest rates, and these expectations of a rate hike, even a rate cut, even if we won't get a rate cut, will represent a downside risk for Australian dollar. If we are talking about the New Zealand dollar, the picture is more or less the same. The currency has strengthened so far, and strong currency is not in the interest of the Reserve Bank of New Zealand, so it may try to somehow change the situation. The market may also expect some rate cuts, and these currencies will have to fight the strength of the US dollar if the Federal Reserve proceeds with its plan to increase interest rates 3 times in 2017. Of course, we remember that when the Fed increased rates in December 2015, it planned 4 rate hikes in 2016, and actually there were only 1 rate hike, and as well in December also. So we don't need to be overly we don't need to take these forecasts of the Federal Reserve for granted. The reality may diverge significantly from the forecasts of the Federal Reserve's members, but still, the fact is that the US economy is feeling much better than other economies, and the Federal Reserve is much closer to raising interest rates than other economies. So the general scenario is that unless we have some political shocks from Donald Trump, the US dollar will have a mildly bullish bias in the next year. And also, I'd like to point out that Donald Trump will become the actual president of the United States at the end of January. So this is when the real thing is going to start with Donald Trump. So pay attention to this time frame. Talking.